Greetings. My name is Sunil Sharma. I'm the Chief Investment Strategist at Ambit GPC, here with your monthly strategy update for August 2025. Let's get started. I will start with a look at the global economy. Over the last few months, 85% of central banks have been in rate cut mode, and most of the major regions, Europe, US, China in particular, have been in discussions on stimulus to kickstart their regional economies. As a result, we're starting to see improved data coming out on the global economy. There's the global composite PMI, and the services data is actually leading the composite higher. We're seeing the same in the regional data as well, with the US composite and the Eurozone showing signs of upticks. And within the emerging markets, China in particular, and a bunch of other emerging market economies are also showing improvements. Now, coming down to the US economy, and we'll deal with markets separately. The U.S. economy has unfortunately been showing signs of weakening, and that's been the case for a while now. So nothing new there. What we'll just track the data. What we're seeing is that there is a worsening of the trends on consumer delinquencies. Serious delinquencies by age group are all rising, in particular the younger. Demographic seems to be bearing the brunt. Looking at wage growth, we prefer to look at data supplied by the hiring platforms. And so those are reporting wage growth roughly in the 2%, 2.5% range. And so real wage growth essentially flat. Looking at the employment picture, jobs getting harder to get, a number of other data we share in the commentary, basically showing a worsening employment picture alongside the other reported data that came out on non-farm payrolls and the adjustments. So again, worsening picture on employment, and on the unfortunately stagflationary setup is the very hot PPI data that came up 3.7% year on year, and that is also worth keeping an eye on. Now, coming to the US markets. So the Mag 7 reported great numbers again. What we would note, however, is that there has been a tapering or a deceleration in the top line momentum, which doesn't mean we're changing our view. We remain bullish on technology, and Mag 7 in particular. We have been bullish for a while. But we will note that there is somewhat of a slowdown on the top line. Now, a couple of other areas of, I guess, note at this point is that the tech and communication services weight in the S&P 500 is higher than it's ever been, higher than 1999, 2000. Again, back then there were no earnings and there were no business models. Today we have dominant business models. Today we have strong earnings, strong margins. So it's not comparable, but it's certainly a very large concentration. Coming to the S&P, which for us is a proxy for, in a way, looking at just the valuations on non-Mag 7, very high relative to history on that front as well. The valuations in S&P are rising, and so these are things that make us incrementally less bullish and slightly more watchful for what's happening in the US markets. And we'll also note that while the hyperscalers came out with very enthusiastic reports on AI and reaffirmed their capital investment guidance, there's also reports coming out of like the survey from MIT that found that 95% of Gen AI projects have been failing, and 85% of corporates have not been able to get a meaningful or any kind of return on investment. So that's something to also keep an eye on. Coming to India, this pie chart shows Russian exports. India is 37-38% of Russian exports, and then China is another third. And very interestingly, 25% of exports from Russia are actually going to the Europeans. So that's something that is that India has been putting out, and it's what the data shows. The second point that was made about India changing partners or increasing its Russian oil imports. Again, Indian oil imports from Russia are basically trending at the same levels they have for about at least 2 years now. India's trading partners are largely unchanged. So what we think, and we'll talk about the impacts in detail on the next slide on tariffs, but a lot of good will come out of this. India-China relations are on the mend, and China welcoming Indian goods. Exports to China from India are actually up 26% year on year. So clearly, the trend is already underway and likely, hopefully, to improve. Similarly, Russia has welcomed Indian goods, and discussions on FTA are underway, energy exploration, technology, defense ties deepening, etc., etc. Lots likely to come forward on that front. Similarly, India, Japan. Japan's announced a doubling of its investments planned in India, 10 trillion yuan. And similarly for India, Africa. A number of nations have been in discussions with India on UPI, on IIT institutes, on Aadhaar platforms, on collaborating on energy, on agriculture, on rare earth minerals, and a number of agreements have also been signed. So we are seeing increased trade activity between India and Africa. And similarly, India Brazil, there's an interest on deepening relationships on particularly deep water exploration and exploring other trade opportunities between India and Brazil. So, as a result of these and many other ongoing conversations, India is likely to emerge more diversified and possibly stronger. Now, the other meaningful impact of this whole thing will be that India will be essentially improving its or de-risking itself further from the dollar and also from the any potential impacts that may arise out of the debt situation, that is the very high indebted situation of the government in the US. Then on lack of clarity on that, how that unfolds. Coming to the tariffs, so we highlighted the industries that have significant absolute exposure of international sales, and that's international, not U.S. sales. So the U.S. sales could actually be a much lower number. According to our analysis, 17.8% of listed companies by market cap have exposure to international sales. The US number is likely to be around 3 or 4%. And that ties in exactly with what we saw on the economic analysis on GDP. Looking at these four industries, we note first of all that pharma is excluded from the tariffs. IT, being a software and services industry, is also excluded. There are implications on the visa side, but companies are likely to find ways to work around that. And the iron, steel, aluminum, a number of the ferrous and non-ferrous metals are also excluded, as far as we know from the our initial interpretations of the trade document that's being circulated. And auto components are also seemingly excluded. We'll know more as we move forward further, but clearly those are the largest industries, and they appear to be having minimal exposure to tariffs. Please look at the Nifty 50, and again, rhetoric versus reality. The rhetoric has been that the Nifty earnings haven't been great. So we delved into the numbers a bit deeper, and we chose to eliminate two companies. One is Tata Motors, because that's largely a international sales company and not representative of what's happening in India, really. And second is IndusInd Bank, again, not representative of what is happening with large cap private banks such as ICICI and Axis, etc. So when one does and is experiencing company specific problems, so when one does that, what we found was the Nifty delivered 6.8% top line growth, which is essentially in line with GDP, and 14.1% bottom line growth. So very respectable numbers and very different from what is being talked about by the media. So I think that was one of the things we wanted to highlight as again very respectable performance that is not being recognized by those that just look at index level data. Earnings on the mid cap same 5.7% top line, but a very respectable 17.3% bottom line growth, and again, led by consumer healthcare and IT. Many sectors delivering double-digit top line and bottom line growth, and these numbers are likely to improve as we move forward. And we talk about the fundamental picture, the macro picture that is extremely positive. Small caps also similar numbers: 6.9%, 13.1%. And that improved towards the tail end of the earnings season. So again, fairly respectable. Could be better, but 14.6% X energy is again fairly respectable for a quarter that was expected to be quite tough based on all the macro worries and around tariffs. And so coming to the outlook, we look at we try to look at things from different perspectives. Looking at where we are from a business cycle perspective, we are currently in an environment with low and inflation. We are currently in an environment where commodities are weak. We are in an environment where ISM is improving. We are in an environment where bond yields have bottomed at the long end and are rising. And short rates have been falling, sorry, and nearing a bottom. And the economy has been showing signs of improvements on credit data, which I haven't shared, but credit has appeared to have bottomed. And the ISM data also has, we hit a multi-year high on the ISM data, on the flash data that came out this month. And we've got a central bank that's cutting rates and accommodative. That is a classical recovery cycle setup. And so we remain, very positive in terms of where we think India is in terms. There's a cycle. It's at the bottom of the cycle and turning up. Now, supporting our view is a bunch of things that are being done on the monetary, fiscal, and tax side. With rate cuts, two more expected by markets. Rate transmission is underway, and that is only about 40% of the way through. We expect these rates to be to come down further as we move forward, and that will help with the disposable incomes with our higher margins. We've got the tax cuts, we've got the government capex spending, we've got structural reforms. So many different factors working in favor of our markets and the demographics and all the other favorable aspects of India's story remain in place. We remain fairly positive on India and continue to hold a overweight in equities, uh, very overweight. We are also overweight REITs and InvITs. And on fixed income, we've tweaked our duration to be to underweight and more focused on the credit risk and the corporate bond side of the market. And in particular, with the rising, improving upgrade downgrade ratios on corporates, that remains an area of focus for us, as well as playing the credit risk part of the curve. In terms of alternates, our views remain unchanged, and those precious metals also we remain overweight. That's it from my side. See you next month. Thanks for watching.